Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
This week we have two picks with building positive trends on them, building positive outlooks. Our strategists, Ben Rains and Dave Boren, who joins us via Skype, are going to fill you in on each of them. And Dave, we are going to start with you. The company that you're going to talk about is a recent IPO, right?
It is. It was actually a spin-off. Trinity Industries spun off their infrastructure division, but Arcosa Industries has been public for only a little over a year. Went public at the end of 2018. And there's basically been one driver of market action for the past few weeks, and of course it's been the spread of the deadly coronavirus. Now, although almost all the cases so far have been inside mainland China, investors are really getting a look at financial markets around the world as they react and realize just how many companies and businesses either deal with sales to or from China. Investors are increasingly looking for safe places to put their money that won't be affected even if the outbreak gets worse. Last week, the yield on 10-year government notes went to 1.5%. So that's basically the same level as the target rate for overnight rates at the Fed. And so that means the yield curve is extremely flat, and there's really not any significant yield at all in the low-risk debt markets. In that type of environment, another sensible place for investors to put their money is in the shares of U.S. corporations that'll have minimal or no effect or drop off in demand from things like travel restrictions and the Asian quarantines. And one of the best of that bunch is Arcosa, symbol ACA. It's based in Dallas, does all of its business in North America and primarily in the United States. It's an infrastructure supply company. Its business is divided into three divisions: construction, energy, and transportation. So construction provides aggregate and specialty materials as well as consulting services for large construction projects, roads, bridges, big buildings. Energy division makes huge wind turbines for electricity generation, and then also structures for power transmission and industrial-sized tanks for fuel, liquid storage tanks for fuel. And then the transportation division primarily makes barges, river barges, and they have a multi-year backlog of orders as one of the only large-scale suppliers of barges. Now, I'm fully aware that none of that sounds terribly exciting, but that's actually kind of the beauty of Arcosa's business. They sell products and services for huge projects that take years or even longer to plan and execute. These aren't the kind of projects that come and go on a whim like CapEx for the next quarter or two for a normal company. States and municipalities make these decisions and they allocate the funds years ahead of time for big infrastructure projects. So for a company like Arcosa, it makes revenues very predictable, and their proverbial dance card is completely full for the foreseeable future, with orders outstanding in all three divisions. Revenue and earnings are expected to grow in the mid-teens over the coming year, which is pretty impressive for a firm where the results are so steady. Arcosa is a relatively new company. As I mentioned, it was created when Trinity Industries spun off the infrastructure business in late 2018. So they've reported as an independent entity for the past 3 quarters. The smallest earnings beat so far topped the estimates by 40%, the largest being an 80% beat. So although they're not exactly a household name or a very sexy story, it's that kind of earnings performance that makes Arcosa a staple in the portfolios of private investment groups like hedge funds and family offices. The shares are basically up about 50% since the IPO, and yet they still trade at a 12-month forward PE of just 17 times, which is lower than the S&P at about 19. So it's not hard to find stocks that have a more exciting story, but it is hard to find stocks with that kind of stable outlook, near constant demand for their goods and services, and that are also naturally resistant to fluctuations because of the latest ripple in the news cycles, like, for instance, the coronavirus. And that's what makes the Arcosa my top stock of the day.
Okay, we'll take it. Ben, you are going to talk about a company that, I don't know, maybe a little bit more exciting, Deckers Outdoor, right?
Yeah, so Deckers Outdoor is a footwear maker. Their biggest brand is UGG. It still makes a majority of their money, but it's not their biggest growth brand anymore. That's actually Hoka 11, which is an outdoor-focused running shoe brand in the last quarter. So they just reported their Q3 fiscal 2020 results last week, raised full-year guidance, big blowout quarter. In that Hoka One One brand was up 64% in the quarter to almost 100 million. And combined with UGG, they account for over 90% of their sales. So those two brands doing pretty well so far.
I was going to ask, is UGG taking a back seat?
Yeah, UGG is still making almost $800 million for them. So it's still a big part. It's most of their sales, but it's just not growing as much as this Hoka One One brand has.
Okay.
And that's been growing for the last several years, and it looks like it's going to continue to grow in a big way. So now I'm just going to quickly go ahead and take a look at just their website for anyone who's looking. As I mentioned, they have UGG. That Hoka One One brand is now there as well. Teva, Sanuk. So it's an outdoor-focused shoe brand. If we go just to the Hoka One One website, you can see, and I encourage anyone, look around. I see them more and more often in Chicago than 3 years ago. I'd never even heard of this brand. Now I see them all over the place. So definitely something, it's anecdotal, but it's something you see all the time now with just people walking around or running. You see this logo, and they're kind of goofy looking shoes in my opinion, big thick soles, but maybe that's why they're so comfortable.
You pay a lot of attention to people's feet in public?
Hey, you know, shoes are a big deal. And then so we can see they've gone on a pretty impressive run over the last, this is a 5-year chart, but the last 3 years have been really good. So if we go to the 3 years, we can see the stock's up over 300%, blows away its apparel market's average of 63%. And then despite this climb, and it's sitting right around its new highs, it jumped right after they reported last week. And despite this climb, it's still trading at a discount compared to its industry. And it's trading at a discount still even compared to it where it has over the last year or so. So that's a good sign for a stock that's really gone up in a big way. And then I'm going to quickly look at their sales for the last couple of years to give people a sense when we look ahead at how comparable it's going to be. So the last several years, they've done they did 6.2% top line growth in 2019, 6.3% the year before that. So then we go ahead and look at what to expect. We're calling for 6% growth in fiscal 2020, and then another 6% growth in 2021. So 4 years straight of 6% top line growth for this company that's been heading in the right direction. We're calling for about 6.3% growth in the bottom line this year, nearly 8% growth in the bottom line. Next year, it had all these estimates come up in a big way since they reported for their fiscal 2020 and 2021 up in a big way. And then if we look at their earnings consensus and surprise chart, we can see that their estimates have really just, for the last 3 years, been trending heavily upwards, and that stock price is just going up along with all these estimates. So it's really a company to be paying attention to, and it's this one Hoka One One brand is driving growth, but UGG is still doing very well as well. But they look to be in a good position going forward.
All right. Do you own either of these two stocks?
I do not.
How about you, Dave?
I don't own any personally. Arcosa is on the focus list, which I write about in the weekly market analysis.
You own any of these shoes that he's talking about? Or? I guess not.
Oh, do I own the shoes? No, I don't own the shoes. I heard they're goofy looking, though.
All right, thanks. And thank you both for all that information. Don't forget, more stock information is on our website, Zacks.com. Get on over to the homepage and check it out. And you can also get advance notice of positive earnings surprises. Zacks Research Breakthrough now predicting with near 80% precision which stocks are going to beat earnings expectations even before their reports are released to the public. And you can see which stocks that algorithm is picking now by going to Zacks.com/promo for details. With Ben and Dave, I'm Terry Ruffalo.